Hello, my name is Sandra Schaefer, and I'm going to be taking you through the question S5-8 in this video tutorial. This question can be found in the study plan on Pearson in chapter section 5.2, or you can also find question S5-8 on page 154 of the workbook. I've put the question here in Excel to go through how to answer it. In this question, we are Bannon Drugstore, and there are a few transactions that have occurred. First requirement is to journalize these transactions, and the second requirement is to calculate how much the inventory cost is for the Bannon Drugstore. Some steps over to the right here to go through in answering these questions. First, note what inventory system is used. It's important to understand whether you're using the perpetual or the periodic inventory system, because that will determine the types of entries that you're doing. So in this case, the system that we are using is the perpetual inventory system, and it tells you here in the question that the company uses a perpetual inventory system. Second step is to read the question and what is required. We know that we have a few days worth of transactions that we have to journalize. In the question, you are given the dates on the study plan question. I believe in the workbook, these are all blank, so you have to put those dates in. And then you have to calculate the overall inventory cost after these transactions are completed. The third step is to determine if you are the buyer or the seller. Again, it makes a difference as to the type of journal entries that you're recording. So that's a very important step to note. Am I the buyer recording transactions, or am I the seller? In this case, Bannon Drugstore is the buyer because Bannon is purchasing inventory. So Bannon Drugstore is the buyer. That means that these entries will involve a number of inventory accounts. I have a slide here that I use to summarize all of the different types of entries that happen with respect to inventory when we are the buyer. You can purchase inventory, you can return inventory, you can have an inventory allowance or a dollar reduction if there's some damaged goods, for example. You can get an inventory discount when you're making a payment for the inventory that you purchased. And sometimes there's shipping involved in inventory transactions. So this is a summary slide I like to keep handy as a reference in order to help me out with these types of entries. When we are the buyer recording transactions, you'll note that the inventory account is involved in every single transaction. So it's kind of something I try and keep in mind. When I'm the buyer recording entries, I'm going to have the inventory account involved in all of the entries. So let's go up to the transactions and record these journal entries. On February 2nd, Bannon buys $22,300 worth of inventory on account with credit terms of 2/15 net 30 FOB shipping point. So to record the transaction on February 2nd, we are purchasing inventory. Inventory is an asset, it's a debit account. To increase inventory, we are going to debit the inventory account. Now, when I'm doing these questions, I like to figure out my debit and credit accounts first, and then I go on and do the amounts. So that's my debit account. My credit account, well, are we paying for it or it's on account? No, it's on account. So I'm going to have to set up a payable that will be payable in the future. So buying inventory or purchasing inventory on account means that you're going to pay for it later. So I have my two accounts. Now I have to figure out my debits and credits. Well, in this case, it tells you it's $22,300 worth of inventory. So that simply is your debit and your credit. The next transaction is where Bannon is paying $150 freight charge. Now, in this first transaction, they say that the FOB is FOB shipping point. One thing to keep in mind when you're talking about freight or about shipping transactions is FOB destination means that the seller is going to pay, and FOB shipping means that the buyer pays. So you have to answer two questions. Which one are we using, shipping or destination? It tells us we're using FOB shipping point. And are we the buyer or the seller? Well, we're the buyer, which means that if it's shipping, FOB shipping, we are the buyer, and so therefore we are going to pay. So here is the journal entry that we have to record for the freight charge. Typically, when we pay a freight charge, it's going to be cash. And in the scenario when you have the cost of shipping, we always add that cost right into the cost of inventory. So the cost is not a shipping expense, it's actually the price of the inventory includes the amount that you had to pay if applicable for shipping. And the credit, well, we paid for it already, so it is a cash transaction. And for the debit and credit amount, it tells you the amount was $150. So we record the debit and the credit. Now on February 9th, Bannon is returning 5,900 of the merchandise due to damage during shipment. So when we do a return, we have, in our first entry, we set up an accounts payable amount for 22,300. Well, now that we're returning some of this inventory, that accounts payable amount is going to decrease. We won't owe as much because we've returned some of the inventory. So because accounts payable is a credit balance account, you would credit it to increase it, which is what we did up here. But if we're going to decrease accounts payable, we're going to debit accounts payable. And reverse to the entry that we did up here, we're going to reverse inventory by crediting inventory. And the amount that we are going to record is the amount of the return, which is $5,900. So again, we purchased inventory in this first transaction where we increased inventory. We've returned some of it. So we're simply reversing the entry that we did on February 2nd. We're reversing that entry, but only for a part, the amount that we've returned. In the last transaction, Bannon actually pays the amount that's due, the full amount that's due from this set of transactions. And it says that we're paying the amount less the return and we're taking the discount. So typically that is another question that I would ask when going through these transactions. When the account is paid, determine if the discount is being used or not. Here, the transaction tells you they're using the discount. Sometimes that's not always the case. Sometimes you have to figure out from the dates involved whether the discount can be used or not. From here, we purchased the inventory on February 2nd. We paid for it on February 14th. That is well within the terms of the 15 days, so we can take this 2% discount. And as I said, the transaction actually tells you you're taking the discount. So then you have to go and calculate the discount, which in this case is your 22,300 initial amount of inventory that you purchased, less the amount that was returned, less 5,900, and then multiply that by 2%. And the answer that you get is $328. So going over to my debit and credit accounts, when I'm actually paying an amount that is due, I'm zeroing out my amount that's sitting in accounts payable from these transactions. So I'm going to decrease accounts payable. And I'm also going to pay out a certain amount of cash. I know the cash is a credit because I'm paying the amount and it has to be a credit to cash. But the amount of cash that I'm paying out is not the full amount that is in my accounts payable account because I'm taking advantage of a discount. So when you're doing a discount, it's going to offset the amount of cash that you have to pay. Because I know that the cash is a credit, then that means that my discount is also going to be a credit. Because the cash plus the discount is going to equal the full amount that I owe on accounts payable. Now, in this, when we're doing these journal entries regarding inventory, when you're taking a discount, you're reducing the cost of the inventory. So we're not recording it in a discount account. We're actually just recording it in the inventory account to show the reduction of that cost. Now, to do the calculations for accounts payable, we know that we had 22,300 less 5,900. So when you calculate that, it's 16,400. That's still in our accounts payable account that needs to be paid. So that's going to debit accounts payable. That will zero out the balance owing. Now the cash amount is going to be some net amount. We calculated the discount over here, so we know the discount is going to be $328. And then to calculate the amount of cash that's actually paid, you take the 16,400, subtract your inventory discount, and that will give you your $16,072. Remember, when you're doing these compound journal entries, you always have to balance out total debits will equal total credits. So it's really important to double check that when you're done your transactions to make sure you've recorded your debits and credits correctly. The second requirement is to calculate how much inventory cost Bannon Drugstore has. So inventory cost is simply adding up or subtracting all of the transactions that have affected inventory. So in order to calculate that, we are going to take our $22,300 plus our $150 minus $5,900 and minus the discount of $328. You take all four of those amounts. The total cost of the inventory is $16,222. Now, a key point to keep in mind, when you're calculating the discount, we don't include any kind of freight or shipping costs that were recorded in inventory. We don't include that amount when we're calculating the discount on the amount to be paid. Because remember, this isn't involving accounts payable. It's a cash transaction that we paid the shipping cost. When we're calculating a discount that the supplier has given us on this accounts payable, you can only include the accounts payable amounts in order to calculate that discount. So the $22,300 minus the $5,900, and then multiply that by your 2% to get the $328. And that is question S5-8.